Jen, I'm sending you a
Yes.
new chart.
I'm gonna retweet it, Jen. Are
You're
we up
sending
and
me
running
a
yet?
new housing chart?
Yeah.
Okay.
Right.
Jen, we're live. All right,
We're live. I have now officially
I'll
joined the show.
retweet the. Well, Jen, you have the good insights, you know.
I'm just a good shopper.
Isn't every woman almost by definition a good shopper?
Yeah.
Oh,
Wow.
just saying.
Wow. Nice.
Yeah. Careful, Ben.
Those dames
Careful.
can shop. That'll be our first segment. Dames
No,
shopping. It'll just
it's
be
a
three
skill.
guys talking about the skirts
Dames.
going out there shopping.
It's a skill.
So those
Dames.
lady folks, they can do some
Birds.
shopping, can't they? Holy crap.
The broads.
The frauds.
Okay,
All
I'm
right.
gonna mute myself
All right.
now. Have an awesome show.
All right, that's Jen, the producer.
Thank you, ma'am.
Ma'am. No, that's worse.
Well, I mean, you objected to our anachronistic terming, so okay, you can be a broad, you can be a dame, you can be a skirt, or you can be a
yeah,
ma'am.
it's better
Giving
than,
you a whole menu of options.
better than ma'am. Okay, now I'm really leaving. Bye.
Not a pejorative one in the slot.
Do you guys also see that Trump's getting in the business of investing in rigatoni computing and these things? that was a new low. You know, I'm short the rigatoni since last week, and all the other bubble stocks are shorted. And I saw that, and I was like, oh, but it's not up that much. I mean, like it's just kind of a headline. But I mean, what are we doing here? We're
You know, it would be
Government's
awesome. That's
putting
on
money
nobody's
into meme
playbook.
stocks.
He needs an 85-story condo on the East Wing. Just the Trump East Wing condominium complex would be freaking amazing. And I mean, it's Washington D.C. has no
gold.
mega tower
In gold.
condominiums. And gilded. The whole goddamn thing would be just gilded, top to bottom, just pure gold, just an enormous phallus, and just have them out there. Just it's 4 times the size of the Washington Monument. That's right. It's going to dwarf that Washington's monument. It'll be beautiful.
Hey, Ben,
It'll be.
what do you think about the mentality of this administration, you know, taking equity stakes? And it sort of reflects the general consensus that equity prices are going to go up. And
I mean, I think that's how people take it.
Yeah. And the question is that what you should be doing with taxpayers' money? Is making these?
No.
I mean,
it's not.
Charlie, they didn't
that's-
pay for
that's-
Intel. They're just taking the companies. It's what are they doing with tax holders?
Just
Their
taking.
cost basis on Intel is 0. So that's a really
Hey.
good stock trade. I mean, they could flip it. They can do almost anything if you don't pay any real actual cash. You just kind of
Well, the other thing that I'm curious about is these equity stakes. Like, what's the plan with them? When we took a stake in AIG, right, and got all those warrants, they brought it back. You know, I remember doing some of those secondaries, and they sold it. Now Fannie Mae, they just took and kept that $20 billion a year of profits. They're just like, nah, you know what? That's gonna help the budget line. Like, we can use that revenue line. But like, I never really understand if a government takes stakes. Like, is there an internal portfolio manager, or like who's making the decisions? Is it the Treasury Secretary? Like,
is there any paperwork whatsoever on these other than just like scribbling in crayon while you're taking a crap? We're going to take 10% of Intel and it's going to cost us nothing. And I think that's the amount of thought that's gone into it. I think you're overthinking it. That's for other administrations to solve.
Isn't there some sort of?
I mean, really, I don't think there's a document you can go out and read about it. Like, are there detailed plans? I don't know. I haven't heard any. I haven't even heard of any that, there aren't documents that I'm even ignoring on it. I don't think there are really any fine print to read.
The only thing you can probably guarantee is that Cantor will be getting the deal to sell it. Whenever they sell that equity to the street, Cantor will be the lead book runner.
Because why would you not go with the best, baby?
Speaking of Cantor, I saw one of the emails that I got. Somehow they send me emails. They were bringing Jensen around, and I'm just laughing my ass off thinking about Cantor getting the #1 big dog CEO of the world. Like, that's like Roth Capital being like, "Hey, we got Bill Gates coming around." Oh
There's
God!
not a lot
All
of
right,
shame. People long shame are getting killed this year.
yeah,
Ben, would you,
shame.
Ben, on these Rigetti, these quantum computing stocks, would you short them again if they jump today, or
Well,
do you
I'm
wait for?
short. I didn't. By not covering, I guess I'd say that yes. I mean, these things have like $5 million of revenue and they have $15 billion market cap. I mean, I don't know what we're talking about here. The There's a
Counterpoint
lot
is
of
we're openly talking about a super corrupt administration that's going to plow business into them and just took an equity stake. That would be the counterpoint. I mean,
well, they didn't
that
take an
buys you a
equity
little
stake.
cushion. They borrowed,
I'm
or
sure
they
that what happened there, if we want to be honest, is yes. So if everyone knows, yesterday was an absolute implosion in bubble stocks, and on the show last week, or so I don't know, last Thursday and Friday, I decided to get back in the bubble stock shorting game. I hadn't done it in a while, but it was like kind of a perfect storm of 2 months of retail call buying, and then dealers hedging that, and then the hedge funds in just hell having to buy that to cover or to hedge their shitty shorts positions,
yeah.
and it's just like basically ran out of buyers. OPEX was last Friday. The hedge funds kind of cleared a lot of their books. They degrossed, and then retail maybe bag hold it. So yesterday we had these things. I had five shorts down double digits yesterday. I don't think I've ever had that before. Like that, it was insane. Yesterday was like the best day ever, and because all the longs were up too, and like I wonder if they just saw that and they're like, well, we can't let this get going. You know what I mean? Let's get a headline out there and like, well, we'll put 10 million bucks in there, which is really nothing. It's just a drop in the bucket versus $10 billion of cap. But it arrests the down move. So in some senses, they're managing the market like they're the Kremlin or something.
Very much like that. I mean,
Jen,
it's
Jen,
pretty openly.
Jen wants us to get going here.
All right, Jen, the producer, says it's time to stop bullshitting. I am Benjamin Brey. This is Jeff Macke and Charles Peabody. This is Wall Street Beats. We're coming at you on Thursday. Jeff, let's start it off. What are we talking about?
I don't know.
See a
Is it
little
time to start
retail life.
bullshitting again? Now that we've done the intro, it's time to get going again on the bullshitting. I was
Let's get
listening to
back.
Hasbro this morning, of all kind of bullshit companies, as part of the retail theme we've been talking about a little bit. But just watching these tariffs play out and how it plays with the consumer. Try to get into it more, but they had basically the same quarter as Mattel. I was selling some ball on Hasbro yesterday because it's the earnings are fine. And you saw a lot of retailers were delaying orders into the fourth quarter. That's super good for the toy companies of the world. That's super good for to have retailers chasing inventory 63 days before Christmas. That usually leads to pretty fat margins on stuff like your Play-Doh and your little dollies, because all the retailers are understocked. They've all been trying to play this tariff game. It matters quite a bit. We haven't seen many huge blow-ups, but companies like the Wilson baseball glove company, they lost $50 million because they brought in goods during like one spike in the tariffs. It really matters when you take possession of these products, when the tariff kind of rate changes constantly. So the retailers are playing chicken with it a little bit. But bottom line is the margins remain strong. The economy, the bet this year has been that we're not going to tip into this massive recession. And people can complain about it and they can moan about it, but it's just not happening. So you saw Hasbro, you saw Mattel make good, basically really kind of nice numbers, decent numbers, great Q4. We've had the retailers selling off since they reported last month. They're coming back a little bit. Ben, you and I were talking about during the bullshit portion of the pre-show. Target getting off the mat, Best Buy getting off the mat. That's really the only places that you can find a lot of value right now. It's nice to be excited about Walmart. I'm a trapped long on Walmart. I would love them to break out. They're 40 times earnings, and they're going to grow at like maybe 5% if they really hit the cover off the ball. Nothing's happened good at Best Buy in 5 years in terms of consumer demand, in terms of just excitement or a reason to even go to Best Buy. I think it's a really well managed company. So I'm kind of keeping an eye on where you can find value, which is in some of these deeper sort of hated names. I'm still long American Eagle. Best Buy's getting a little frisky. You got Nintendo up in their orders for the Switch 2, which again, there weren't a lot of people getting super excited about that. They're selling them as fast as they can. I have no idea who plays the handheld console things in the world, but I know it's absolutely bullish for Best Buy if you have people lining up to buy those. The Meta glasses, it's not going to be a huge category for them, but it's an incremental reason to go to Best Buy, and they haven't had store traffic in quite a while. So I'm kind of picking through the refuse of the non just perennial winners. There isn't a lot of value in Costco anymore. They're not the scum of the earth. Hard to get excited about the stock, but you do have some room. I mean, Target at 10 times earnings, I have no reason to be excited about them. I hate them a lot. It's more or less an intellectual exercise to like what could go right for them. Well, what could go right for them is we're going to have the biggest Halloween ever, which is not how consumers behave when they're feeling tapped out. People don't go on kind of comfort flights. I'm worried about losing my job, so I'm going to go just pay top dollar for a seat on Delta and fly across country. We're behaving like the economy's just fine. And so I'm just looking for plays that are just going to beat to the upside and trying to find some low multiple. The pickings are a little slim out there. It's been a bifurcated market, and it's hard to see these stocks picking up a lot of momentum. But Ben, as you know, sometimes when the story's really hard to believe, that's when you get the best opportunities. And so that's sort of where I'm picking through as we get into the end of the year, and you have that classic kind of end of the year. What do you want to show on your books? Not a lot of people want Best Buy or Target to be big positions on their books. That gives you some upside room if you start moving. If you're buying a juggernaut retail at 10 times earnings, you can look pretty smart without it doing much right. It's 12
Yeah.
times earnings is just as cheap. That's 20% move. That's better than government work, unless you're in particular branches of the government this year.
Yeah, I mean, you have a couple things, right? Like, and again, they've been material moves over the last couple weeks. You've seen Best Buy go like 71 to 82, and Target go from like 85, 86 to 94. Like, that's a legitimate move. I think, one of the things I'm long is the staples just in general, like kind of stable-ish businesses.
Yeah.
And, Target's had a little bit of a rough period, but like we could get a Chinese deal here in a week or two. I mean, I'm not saying you will, but that would, if you got a deal, that would help be good for them. And I think stable businesses will trade relatively better than, I think tech comes in and those will kind of get a bid, or, like in some sense, like a safety bid. If like Target's, you're not great, but it's one of those things where it's not going out of business. It's just, it has indigestion. So I don't know. I
It's
mean,
just impossible to
you're not
get
getting
excited. I mean, by a
rich.
bad run, it's down
Yeah.
It's down 60% over the last 5 years. So that's one hell of a bad run. They got
Right.
slaughtered after they hired from within. They chose to hire internally when a company needs outside perspective worse than it ever has in the 65 odd year history of Target. And they went to the inside, and the stock was 102 or something at the time, and went straight down to brand new lows. So bouncing hard off 85 and making a nice move, that was a pretty meaningful low there, though. I mean, it's just, these are kind of picked through and picked over as shorts. Once something's done being a short, sometimes you can get a little long and go for a little play there. But again, if you're looking for signs of sort of consumer demand falling off, of Christmas being weak, I'm trying to figure out a way to play the fact that people think this is going to be a down 2% Christmas. I think it's going to be like an up 3 or 4%, just because it's always the biggest Christmas ever. Not the sexiest trade on earth, but it's been a pretty good market year. And so you get into the November timeframe, and it's a little hard to play long ball. And we're seeing signs of kind of a creepy market, like you were talking about, Ben, the bubble stocks. I mean, I don't know if you guys saw 1-800-Flowers yesterday. That went from something like 350 to 8 at one point yesterday, and right back to 350. Is the shortest spike of death I've ever seen. It was the rose stem of death, I called it, in a graph. Normally you get
Yeah.
that Christmas tree where it's kind of a slow build. That was just, we decided it's awesome in the morning, and by 7:30 it was just dog shit and right back into the bin where it came from, and deservedly so. It's 1-800-Flowers. People are like, oh, it's up 70%. There must be a story here. Nope. It just was, who knows? Animal spirits, some guy gunning and running in their basement. Who knows? But man, if you hung around that party, you were like at a Chauncey Billups poker game, man. You were the sucker at the table. You were in trouble.
So you know
Topical,
what else
baby,
did that?
topical.
The Beyond Meat did that yesterday too. It came back from one of those relics of the 2021 bubble. came back and had a 1 day, 2 day,
Right.
cameo, and now it's back down.
And you're kind of picking through it, and it's like, okay, you guys still make an edible food product, right? You still make absolute garbage meat
Yeah,
replacement stuff,
it's
don't you?
it's
It's like that's a tough
questionably
core
edible.
business. My dog won't eat it. I put beyond me years ago, 5 years ago, I put it in my bulldog's bowl. She's eaten a Hot Wheel before. She ate a Lego once. The dog, bulldogs aren't particularly discriminating when it comes to food, and she just looked beyond me like, "What the hell are you putting in my bowl? What? Gross, man. What did I do to deserve this insult from you?" Yeah, and
Yeah,
I assume
not very not very
I
good.
assume that's not going to change. So yeah, there's just not going to be the fundamental demand to pick up on the other side of these businesses. Weird moves though, and not typically what you see in a particularly healthy market. Maybe we're just eliminating some of that FOMO garbage stock type of air pocket stuff, which you got to do in periodic correction. It's been a while since the market's been really down. We've been sort of straight shotting it since Liberation Day, with not a ton of great news happening other than the tariff noise isn't playing out as in a worst case scenario. It's the cost that we talk about over and over again. It's getting split up, a little bit of suppliers, a little bit of customers, and a little bit of margin. So how do you play that from a stock perspective?
Yeah,
Well, the companies become a little bit more expensive, but not worst case scenario. It didn't freeze the entire economic system, just kind of made it more complicated. And for the most part, the companies have really kind of managed it fairly well, or at least better than feared in early April this year.
yeah, and look, I just think that in general, there's just nobody in any of those stocks. Like, restaurants
Right.
are on their deathbed. Retail's kind of been forgotten. Everybody's gotten away over their skis in tech, so it doesn't take a lot for just a redistribution of money, and you don't need to be batting, like hitting home runs or anything. Like, as long as you just can suck less, that actually can work when you're down in the dumps like that. You know what I mean?
Oh,
But let's
absolutely,
talk about.
absolutely.
Go ahead, if you have something.
Oh no, yeah, just to put a button on the point. These are companies that are forgotten. These are companies that you're buying them for 10 times earnings, 11 times earnings. No one's paid any attention to them. The bigger caps, which takes you away from just the pure straight out 1-800-Flowers type of garbage bin. But it's hard to see how you're really going to go totally bankrupt buying something that's not going out of business at 9, 10 times earnings. It's hard to find
Yeah,
many companies
yeah,
like that anymore. And so if the tariff news breaks even a little bit good, even okay, you can see a 1 point expansion in a PE gets you a 10% move in these beaten to crap retailers, and that's not bad.
yeah. And I think let's just bow tie this, and then we can move on. Is that you're seeing some anticipation of that, right? Because I don't think we've
Yeah.
seen any numbers from Target, or any numbers from Best Buy, any numbers from a few of these guys, but you're starting to see, and there's a lot of smart players in the market, and so you have to ask yourself why are they getting bid right now? So there's probably, and then obviously the more expectation there is, the more risk there is, so, but I'm just saying that getting off the mat, there's usually a little bit of room. But the one thing, let's move to Charlie here. Charlie, one of the things that's going on now for a month plus is it seems like the subprime auto space, things are not good there. Like, what are you thinking about that? And then let's relay that into housing, which I know you want to talk about.
Yeah, I think that whole ecosystem of autos is in trouble, whether you're a seller of the product or a financier of the product. And I think it's going to get worse from here. It is the one area that had the weakest underwriting standards of any consumer products area, um, largely because, if you recall correctly, during COVID, um, used car prices went up. And so you got loan to value ratios of 110, even 150%. And many of these financiers were rolling in, the cost of insurance or warranties and stuff like that. So it is the area of the weakest underwriting standards. Um, and I think there were two mistakes that underwriters made. One was assuming that used car prices would never come down, and we've been seeing deflation for the last 18, 24 months. So that means severity is going to go up. So two things we look at as an underwriter is what's the frequency of default and what's the severity given default. And with used car prices starting to deflate, severity is going to go up. The other thing that a lot of lenders assumed was that people would not default on their cars because they needed them to get to work. And with the work from home, social society that developed after COVID, that's been not the case. People are willing to default on their car payments. So I think you're going to continue to see fallout. It's going to migrate from, let's say the corporate sector where we've seen First Brands, Tricolor, American Credit Corp, Automotive Credit Corp, Prima Lend yesterday, to the lenders, which will be, the allies. And in between there will be, problems at the, used car sellers like American Kmart, um, Carvana, I think, is a great short here. CarMax has already shown deteriorating credit in their asset-backed securities. So that whole space is going to just keep deteriorating. So there's no interest on the long side for me, and then you pick your spots on the short side. Sorry, I was a
Yeah,
little long.
yeah. Just full disclosure, I shorted the Carvana last week, or maybe 2 weeks. I don't, it's like 380, 390, and then and so that seems to be the outlier because America's Karma's at the bottom, down 60% in the last couple months, and like you said, uh, like the whole space of the bankruptcies. But one other bankruptcy we just saw. Speaking of Jeff, looks like our friend Saks, 115-year-old company, is sounding like they're going to go bankrupt. They did a debt deal for at par last December that's now trading at 17 cents. And you know what bank
Yeah.
did that
Happy
deal,
birthday to
Charlie?
those guys, right? That was not that turned
Yeah.
out not to be a great deal, man. That fell out of bed immediately, instantaneously.
Oh
Just
my.
just the absolute collapse of Saks was pretty jaw-dropping, actually.
Is that a,
It'll be
was
interesting to see how they decorate this year.
is that a private credit funded,
No, no,
recovery?
no. That was our friends at Jeffries who've been,
Oh, okay.
in the forefront of all this auto stuff too. So they got their hands on lots of bad debt that they've shoveled
Yeah.
onto the street. Um,
I
and
still
their
think
stock has
it's
been
just going to be our cycles, Bear Stearns, but we'll come back to that
Jeffries.
later.
Yes, I think
Yeah.
that's all right. So let's go to the housing stuff that you have on the
Yeah.
list today.
Yeah, listen. In full disclosure, I'm as bearish as I've ever been. I really am very, very bearish. So I just want to put that out there so you can filter my commentary according to my biases. Back in April, when everyone was bearish, I literally was writing, and it's in writing, so it's not revisionist history. No recession, buy stocks. So back in April, I guess the way I would phrase it is, when I saw flowers, I would ask, "Where's the party?" Today, when I see flowers, I'm asking, "Where's the funeral?" So that gives you a sense of a change in mindset. Um, so and there are two industries that lead me to this bearish conclusion. One is what's going on in housing, and the other what's going on in banking. And so let's start with housing because that is has a major multiplier impact on the economy. And as you know, since last September, I've been highlighting the bearish, you know, bearish news around expectations around housing based on, an affordability problem. So today at 10 o'clock, we got the new existing home sales. They were pretty much in line at a little over 4 million annualized, but that's a very depressed historical level of home sales. Um, Jen, if we can go to the next chart, this gives you some sort of the historical view of that home sales. The white columns are the existing home sales, which came out today. The salmon colored columns are the new home sales that'll come out. I think it's on Friday. Um, and the expectations for new home sales, which come out Friday, are fairly elevated relative to recent history. So there's expectations that this lower rate environment is going to improve the housing industry. But yesterday you had three different home builders report. I think you had MI Homes, you had Taylor Morrison, and you had NBR. And two of the three beat on the bottom line, but all three stocks sold off 2-3% yesterday. And the reason they sold off is they're forecasting further pressures going forward. And there are four things that are pressuring, these earnings outlooks. The first is margins continue to be pressured And that's really due to elevated incentives. And the incentives really are revolved around the mortgage buydowns. I mean, these new home builders are offering 4% mortgages, and they're still having trouble moving product. So today, if you get a 6% mortgage in the public markets, it's not competitive with what new home builders are offering. The second is you've got higher land costs. Home builders have been depleting the low cost land that they bought during COVID, and now they're facing higher plots in their margins, higher cost plots in the margins. The third is that the spec, levels of homes out there still remains very high. I think that there's about 7 or 8 months of supply of new homes, with a large part of that being spec. And the final thing is that the cancellation rates are picking up. According to Redfin, I think they put this chart out yesterday. In the month of September, 15% of all contracted homes were canceled, and the all-time high is just over 16%. Back in, I think that was in 2020, if I recall correctly, in recent history. So we're not seeing things that would make you optimistic about housing. So that I just wanted to deal with that. Any quick questions on housing and where we're headed? Because I don't know if we get a bounce, here or not, but I do believe that the first bear leg, as I've said in the past, is revolves around affordability. I think that bear leg is done. We've had a bounce over the summer. And so the next bear leg, whenever that is going to start, and I think we're getting closer to it, is going to be a function of lower or higher unemployment rates. We haven't started that yet, but I think that that's coming. And we're going to have deflation in housing prices, just as we had deflation in autos. And eventually, I think we're going to have deflation in stocks. So going back to Jeff, and I'm probably the bear here, relative to Jeff. If we have deflation in home prices and deflation in stocks, that negative wealth effect is really going to hurt the consumer buying. So,
absolutely, I'm always up for a good bull bear fight. I mean, what do you attribute that to? In the car space, for instance, I mean, the age of a car on the road right now is just constantly going up, and you kind of get to a point where you don't need to switch. I mean, I'm driving a 9-year-old car, or my wife is, we were kind of upgrade every couple of years. People to, why the hell would we upgrade? We like this car. Fine. They're making a better product. If you make a battery that lasts 40% longer, it's going to be bad for Duracell. What do you think's happening in housing? What's the equivalent on that? Why are people canceling, and kind of I always look to the human side. To what do you
the,
attribute this
the,
kind of behavior?
these are the value traps, if you will. I mean, the bull case in autos, as you said appropriately, Jeff, is that the average age, I think, is now 11 years or something. It's up there, whether it's 9, 10, or 11. It's somewhere up there, which is
It's an upward to the
extremely,
right graph. I mean, they're getting
yeah.
older all the time.
And so people have said, well, they're going to have to, buy new cars. Or the case for the auto parts was, they're going to have to maintain their cars, and that's just not happening. And the same sort of thing, cases being made for housing. We've got household formation that is outstripping supply, and we've got very low supply in terms of existing homes. I think it's about 4.4 months of supply of existing homes. Therefore, housing is going to be in demand, and it's just not happening. And I think those two arguments have been the value traps around autos and around housing. Um, and it really comes back to affordability. I mean, the consumer, we do have a K economy. So yes, you can still buy your Ferrari, although Ferrari's earnings the other day were disappointing. But it's getting harder to buy the Ford Focus. So its affordability is a big problem here. And I think financing is going to get tighter and tighter, because default rates are going up. So liquidity for these products is not going to be there, in my mind.
But let me push back just a little bit because as everyone probably knows, I'm the local bond bull around these parts, and rates have been going down all year. So we start the year at the rates at the highs, and the market went down, but then it went up. But the one constant is rates have been going down, rate volatility has been going down, mortgage spreads were going down. So now the mortgage 30 years almost to 6% now, Charlie, right? And it still
Yeah.
has over 200 basis points of spread over the 10-year. That can keep going down. We could get just 100 basis points of spread compression, and without even the long, like the 10-year going anywhere. And by the way, the 10-year is below 4% again. just to note that. That will have an impact. Like that will help the housing market. If we let's say we get a sub 3% 10-year and we get 110 bips, 120 bips spread, I'm telling you, 425 mortgages will help the housing market. I mean, like, yeah, I get that the
Yes
how
and
like the
Ben.
employment thing.
Yeah, yes and no. I mean, as I pointed out, new home builders in their mortgage buy downs are offering 3.9% mortgage rates right now, and you're still not able to move a lot of product. If you get down to 5% mortgage rates for existing homes, that probably will spur activity there. um, and whether that creates demand for new furniture from Restoration Hardware, I don't know, or Sonoma or whatever, housing related goods, it could. But what you really need to do is get the new home market going versus the existing home market. And they're still having a lot of problems. And as I mentioned yesterday, two out of the three mortgage housing home builder stocks that reported yesterday beat, but they lowered outlooks. So they're still experiencing pressure on their margins or on their orders. If they're trying to maintain margins, they're seeing their order book slow. So affordability, the theme that I kept, pounding on since last September was things that need to be financed are going to disappoint. And that theme still is playing out today.
And
So
I'm with you. I'm with you on all that. All I'm just trying to say is that, like, I think about it from the consumer standpoint, or just like general economy standpoint, is that if I talked to a buddy I went to high school with, and he had called me and asked me about this when he first got a mortgage, and the poor bastard got a mortgage at 8.25, and so now he's all excited. I know, I know, I know, I know, and he top ticked that, I think, and so now he's refinancing, and I was like, how material is this to your like daily life? And he's like, it's huge. I'm gonna save like $1,500 a month, so maybe that's not per se great for housing demand, but for his life and all these cost pressures that people are getting, maybe it eases up some money to buy some skeleton. And you see, I got some Halloween decoration behind me, Jeff. You appreciate that?
I
Um,
do. I've got some over my right shoulder. It's look
yeah,
at us,
yeah,
just
yeah.
just living the seasons, man.
Seasonal guys, yeah.
Ben, the other
But
thing yesterday the purchase mortgage application index came down again, and I forget but it's a multi-period length of time that we are at a low here. So the recent relief in mortgages. So the housing data that I showed in the table was for September. October is not showing much of a pickup in terms of mortgage applications. I don't know if you can pull it up on Bloomberg, but
Well,
the purchase.
I think there was. I'm not in front of Bloomberg right now, but I think there was and that's why the mortgage refi stocks, which I liked, had a really good run, right?
Yeah.
Like nothing was better than the better. That thing went from $10 to 90, but like that's not like a real stock. But Rocket, went from $13 to I think high of a little bit over 22, which is
Yeah, great
yeah, yeah,
call, Ben.
which I mean, Rocket's about $30 billion, so that's an actual real company, and they're the premier player. And so there was a wave, and I think that initial wave got saturated, and now you need another leg down, basically. And I think you're right. Like I think at 5% mortgages, and people will start moving into the floaters, though, to be fair. Like when rates are coming down, you can go into a floating rate. When rates are rising, who the hell ever is going to go into a floating rate mortgage when rates are going up, right? Like, oh, okay, I'm gonna keep getting a higher bill. Like, no.
Ben, as you and I both have talked about, we're seeing stress at the short end of the market. The overnight funding rates are now trading above the effective Fed funds rate, which tells you there's stress in the markets. It's one of the reasons why I think capital markets are going to experience some problems. And there's a game of cat and mouse being played here between the investor that's feeling the stress and the Fed that has indicated that it's aware of the stress and may come to its rescue. And the question is the Fed going to come to the rescue before we have a dislocation in the capital markets? And, I don't know the answer to that, but that's the game of cat and mouse that's being played between the investor and the Fed. Um, and if the Fed does come to the rescue, it's going to be in the form of obviously more aggressive rate cuts and the ending of QT. And so the way I've been playing that, and going back to your comment about mortgage spreads being very wide, is I've been buying Annaly, NLY, and Agency, AGNC. Because if we do get an end to QT, I think those mortgage spreads are going to collapse. So what they're around 200, 250 basis points, and we should be down around 150, maybe even less than that. And that I think would help, those mortgage REITs. So that's the way I'm playing that expectation as a positive hedge to my negative view of what's going to happen in the capital markets.
Yeah,
But
I own the AGNC, um, kind of around here, like maybe around $10 and something like that. So I haven't made any money on it really yet, but I do like that, and I think that it sounds like they're just going to get rid of QT at this next Fed meeting. I think it's like they're just not even going to mess around. Like, what's the point of delaying it an extra meeting? Like, I wouldn't be surprised if we get that, and I would think the market would take that somewhat positively. But again, we're at all-time highs, so it's just a weird situation where we can sit here and all three of us can talk about Jeff's retailers, which have been struggling, and the restaurants, and we can talk with you about this Jeffries and the auto space and some of these problems. But here we are. The average guy doesn't care because the S&P is at the all-time high and the Qs are right off the all-time high, right? So it's a weird situation, I think. And the Fed being this proactive at all-time highs kind of tells you all you need to know, in my opinion. Like when this thing goes, it's gonna go, and so you might as well ride it
yeah,
for while you can, because when this thing goes the other way, this could be one of those historic other way moves,
and I think
basically.
that's the important message here, which I also relayed on last week in one of my commentaries. That there's a topping process in my mind that's taking place in the financials. Whether it's taking place in the market, we can debate, but I know financials, and I think it's a topping process here. And we've seen in other groups, whether it was the crypto space or the precious metal space, when things turn, they turn violently. And so people who have been buying over the last month all of a sudden find themselves underwater. And it's very difficult to get out of that situation. And I think we're about to see that in the financials here. So, I agree with you. The violence of the moves are going to capture a lot of people that don't. I've been starting to get bearish since September, and so I haven't made any money in the month of October, per se. But I think I'm protecting myself for that potential downdraft, before year end.
Yeah, and I think it's interesting, just to cap this conversation off with Jeff, is that the consumer stuff was the easy stuff to see some softness in, and people just went after them, right? And it was like buying Walmart and Costco and shorting basically everything else, more or less, right, Jeff?
Pretty much, yeah. Those were the companies that were going to be tariff proof, right? You had three of them. You had Amazon, Costco, and Walmart, and they've just kind of taken a huge share, feasting off the Targets of the world, both in terms of market share and just marginal income, and taking more than their share of it. How long that lasts, I'm not sure. Of those three stocks, though, the only one having a decent year really is Walmart, and through an
Yep.
AI kicker, and they're kind of getting more creative, but those stocks have been crap. And Amazon, it really doesn't matter what they do. If they do great on the cloud side, people criticize the retail. They've had their best year in terms of just being a retailer that they've had in a long time, in terms of their profits, in terms of their sales, in terms of their physical performance. Costco continues to crank out cash, but the stocks are dead money. So it's
Yeah.
it's a confluence. I mean, we're the fable of the Chinese guys going out and describing an elephant. One says it's papery, one says it's tree trunks. We're all coming back with our own observations from our private little sectors. But I think it's a confluence of, we have a government that clearly Trump does not want to be associated with a market crash. That is anathema to his
Right.
legacy and to his goals, and he's made that very clear that this shit is just not going to crash on his watch. And we've had a lot of behaviors. Housing, we're having the hangover from the all-time kind of COVID weirdness that we saw there. You have some structural things in places in cars that we've touched on, all of which, I'm just looking for a tailwind. As we always say about retailers, it was a great trade on American Eagle because denim picked up. Denim grows 1% a year for the last 20 years. It's going to grow 8% this year. Someone's making extra money on that. That doesn't mean the consumer's doing great. It just means it kind of sticks to your little private niches, and it's you got to kind of put the pieces together. So it's equally viable to make a case. I just know that what Charlie's saying on the bearish side, again, the government's never been sort of this stated but unstated desirous of just
Proactive.
propping stocks up and letting it gun. Yeah, we're going to fix Intel right now just by taking 10% of them and jamming deals down their throat. Yeah, it's you want to play in chips in our space, you have to do it through Intel. Holy shit, that seems bullish for Intel. I'm not sure what it means for the world as a whole. It seems super unhealthy that we're just taking stakes of companies now. It seems, grossly un-American, but it's bullish, and so no one's really going to care unless Intel falls out of bed.
This idea of picking winners and creating losers, I don't think is a good thing for a free market.
It seems like the kind of thing that just ends poorly just by the very nature of it. Like we're clearly have abandoned the concept of a free market. We used to just nod at it a little bit, and now it's just like, screw that. It seems it's inefficient. What if we just buy 10% of Intel and force other companies to do deals with them? That seems faster. Okay.
Yeah, I mean,
just
let our kids
recently,
mop it up.
Just recently, Trump did a deal with Australia for rare earths. And I own Linus Rare Earths, which is an Australian company that's well managed, well run, profitable. And the investments that Trump wanted to make were in some of these less well-known companies that were losing money. And Linus Rare Earths sold off on that because all of a sudden you're going to have competition from uneconomically motivated competitors. And I just don't see the logic to that. But anyway, sorry.
Yeah,
interesting times.
Let's call it there. I think it is interesting times. I think there's a lot of cross currents. There is, some spaces like consumer that's anticipated some of this stuff. There's some places like now that are getting hit, like this auto space. Housing's kind of a weird one because prices are high, but volumes are just anemic. And yet here we go, the all-time high stocks, which with 50% of assets under management in passive, that's, first of all, it drives it, but then also it's just like a lot of people just don't care as long as the S&P holds in. It's just it's more stock pickers market, and there's things to do. But yeah, it's a very interesting time. It's a fun time to talk with you guys. So anyway, let's call it. I'm Benjamin Brey. It's Charlie Peabody, Jeff Macke, my buddies. Come check us out at wallstreetbeats.com. We'll be here tomorrow. Have a nice day.
Thanks, Ben. Thanks, Jeff.
All right, guys.
Good seeing you guys.